When I first started trading, my biggest mistake was believing that with enough study and the right platform, I could control the direction of every single candle. That illusion came at a high price. Mark Douglas explains that every individual trade is subject to randomness. Even when we have a real statistical edge, it's like flipping a weighted coin that lands on heads 60% of the time. Each toss is still unpredictable, but over 100 flips, the edge reveals itself. The clash between expectation and reality happens when a trader convinces themselves that a foolproof setup should win yesterday, today, and tomorrow without fail. The market replies by reminding us that even the best strategies go through periods of entropy, leaving the trader frustrated for not understanding the probabilistic nature of the game. This disconnect deepens with what I call the joystick error. In the desperate attempt to avoid losses and tame the chart, beginners constantly move stops up and down, trigger endless alerts, change targets with every spread fluctuation. The mind mistakes activity for control, when in fact, it's only amplifying internal noise. The more you interfere, the less you see. That's what happened in 1987. Before the Black Monday crash, many quants believed their mathematical models could anticipate any market distortion. They doubled down, adjusted algorithms in real time, and got swallowed by their own confidence. The market, indifferent to all of it, moved 20% in a single day, wiping out those who insisted on controlling every inch of price movement. So, what's the antidote? First, shift your focus from outcomes to the process. Before opening the book, go through a quiet checklist. How's your energy, your concentration, your risk tolerance? Did you sleep well? Is your written strategy clear about entry point, stop, and target? If the answer to any of these is, I don't know, you've already lost the only control that truly matters, your mindset. During the session, remember that the only variable fully under your command is the faithful execution of your plan, without emotional improvisation. At the end of the day, open your trading journal and write in detail how you felt when the market ignored your assumptions. It's not enough to record entry and exit prices. Write down your anger, your euphoria, your anxiety, that sudden urge to double your position to make it back quickly. After 20 days, read it all at once and you'll notice. It's not the candle that repeats, it's the frustration. That awareness reduces the impulse to smash buttons randomly and strengthens the discipline to accept the randomness of each trade. When you finally understand that controlling the market is impossible, you discover that controlling yourself is enough to succeed. Your edge lives in long-term statistics, not in obsessing over every tick. Free yourself from the illusion of external control and focus on mastering your inner ritual. That's where the market rewards those who honor their own rules. If this message resonated with you, take the next step and dive into the books that transformed my journey. The links are in the description and pinned comment. Grab your copies, study every page, and start building the mindset that separates survivors from the broken. Every trader begins their journey captivated by the visceral thrill of getting a prediction right. When the price explodes exactly where imagined, the brain releases a cocktail of dopamine that reinforces the belief that being right means being good. Brett Steenbarger, a psychiatrist and coach to major prop trading firms, explains that this biochemical reward creates a dependency loop. Each trade becomes a chase for the high of confirmation rather than consistent profit. This breeds confirmation bias, the tendency to filter information to support an existing belief, suffocating the ability to respond to new data. The chart stops being a field of probabilities and becomes a courtroom where the trader is obsessed with proving their case at any cost. In the 1990s, John Meriwether gathered some of the most brilliant mathematical minds on the planet, including Nobel Prize winners, and founded long-term capital management. The fund bet on convergence between similar securities, convinced that spreads would always revert to historical means. For years, LTCM hit its targets with surgical precision, reinforcing the partners' belief that their models were infallible. But when the Russian crisis of 1998 hit, spreads diverged far beyond the standard deviations predicted by their equations. Instead of stepping back, Meriwether doubled down with every market dissonance, seeking mathematical validation. The result was a multi-billion-dollar meltdown that required a bailout led by the Fed. This collapse illustrates how the need to be right can paralyze quick adaptation. Brilliant yet rigid convictions crumble when faced with off-script events. To escape this trap, top-level professionals adopt what I call the language of probability. They describe trades as conditional narratives. If the S&P breaks the previous high with rising volume, then the probability of continuation increases, and I enter with half size. If the flow reverses within 2 candles, then the technical stop is triggered, and I exit the idea. This vocabulary removes the ego from the center of the conversation and reinforces that each analysis is just one scenario among many. It's no longer, I'm right, but rather, the market validated or invalidated my plan. There's a simple practice to dissolve mental rigidity, micro-lot position reversal. When the market clearly rejects your setup, close the position immediately and, with a symbolic size, take the opposite side. The goal isn't to profit from the counter trade, it's to teach your brain that changing your mind doesn't hurt. Repeating this exercise builds cognitive flexibility, reduces the cortisol spike linked to being wrong, and breaks the dopamine loop that fuels confirmation bias. Over time, the trader starts seeing opposing signals not as attacks on their intelligence, but as valuable data that refine their contextual read. A true professional doesn't seek to be right. They seek to stay in sync with the real flow, even if that means switching sides in seconds. Mastering this skill requires constant inner vigilance and the willingness to kill your own ego multiple times a day. The reward is a mind free to embrace uncertainty and a P&L that reflects ongoing adaptation, not brilliant stubbornness. Most traders start out believing that financial pain only comes when the market moves against their plan. But the real sting hits the moment we officially accept the loss by hitting the close button. Ari Kiev, a psychiatrist who trained high performance teams on Wall Street, revealed that this emotional pain can be up to 2.5 times stronger than the pleasure of an equivalent gain. The brain registers loss as a threat to survival and releases cortisol in much greater proportion than the dopamine triggered by a winning trade. That's why we tend to delay stops, invent excuses to stay in a trade, or move our exit to break even in a desperate attempt to save face. What's known as break-even fixation seems logical on the surface, but it often cuts off profitable trends. When we move the stop to zero before the move has matured, we shrink the statistical breathing room the price needs, turning a winning position into just another neutral entry in the journal. Prospect theory, a model developed by Daniel Kahneman and Amos Tversky, quantified the bias that makes us loss-averse and at the same time willing to take excessive risks to avoid admitting defeat. In lab experiments, they proved that most people prefer a chance to win it all back rather than accept a certain loss, even when the odds clearly worsen. In day trading, this mindset appears when a trader cancels a technical stop and decides to see what happens after a streak of losses. The numbers show this behavior increases drawdown and slowly erodes long-term confidence. Ari Kiev saw the same pattern at SAC Capital, where coaches train portfolio managers to follow hard stops with military discipline. It worked until conviction felt too obvious to fail. That's what happened on certain desks when macro variables shifted suddenly. Senior traders requested permission to override limits and recover quickly, claiming superior insight into the asset. Without exception, these decisions led to deep losses that forced upper management to step in. The takeaway is simple. Quantitative systems protect us from the worst in ourselves, but only if we resist the urge to override them at the most crucial moments. To break this vicious cycle, adopt the pre-mortem method. Before entering a trade, take a full minute to write down what level of loss would be acceptable and what lesson would make that price worth it. By clearly defining the expected learning, you turn the stop into a psychological investment rather than a personal defeat. Then, read that note out loud to reinforce that the risk is being taken consciously. This ritual reduces the anticipatory pain described by Kiev because it shifts the burden from randomness to a deliberate plan. Accepting losses as part of the process doesn't make trading easier, but it removes the toxic weight of pride that paralyzes decision-making. When every loss is seen as a logical cost for the chance to capture high-probability moments, the mind is freed from the pressure to always be right. And in that space of clarity, consistency begins to emerge, the kind that separates casual players from true professionals. Most of the struggles you face on the screen don't come from the chart. They come from childhood. Mark Douglas observed that the mind carries hidden scripts about money that act as invisible filters. If you grew up hearing that rich people are greedy or that money corrupts, then every trade that threatens to turn a profit into something too big triggers emotional alarms. These alarms show up as anger when the market takes back part of your gains, or as wild euphoria after just a few ticks in your favor. The real challenge is bringing these subconscious codes into the light before they sabotage your risk management. The technique known as root belief mapping works like a magnifying glass for these emotional triggers. Here's how it works. Every time you feel a strong emotion during the session, stop, close your eyes for 10 seconds, and ask yourself where that sense of urgency or fear is coming from. Don't settle for surface-level logic. Search for the specific memory. Maybe you'll remember the day your father lost his job and your family argued about bills at the dinner table. Maybe your mother's voice comes back, repeating, "Easy money is for criminals." Write that moment down in your journal. Over time, you'll start to notice that these current emotional reactions are echoes of old memories that have nothing to do with the setup in front of you. Jesse Livermore, the legendary speculator from the early 20th century, once turned $10,000 into hundreds of millions over a few market cycles, yet he went bankrupt at least 4 times. Biographers say that, at his peak, he would carry cash in suitcases just to break the feeling of unreality. His pattern was clear: make a fortune, feel guilt, and risk it all again until he returned to the financial zone he believed he deserved. The lesson is harsh. Without internal reprogramming, even technical brilliance can become a weapon of self-destruction. To rewrite your own limits, adopt 2 complementary practices. The first is operational affirmations. Unlike vague motivational phrases, these describe specific behaviors that reinforce both worthiness and responsibility. Say them out loud before each session. I honor every opportunity because my results reflect my preparation, not my worth as a person. This phrasing separates your net worth from your identity and reduces the panic around winning or losing too much. The second practice is micro-exposure. Start with position sizes so small that the amount at risk doesn't trigger your old fears. As you follow the plan without emotional escape, gradually increase the size in tiny increments. This process desensitizes your nervous system, just like exposure therapy does with phobias. If at any point you feel disproportionate tension, stop scaling, consolidate by repeating the same size for 9 or 10 sessions. When execution becomes neutral again, take the next small step. By combining the investigation of root beliefs, Livermore's story as a cautionary mirror, and the behavioral engineering of micro-exposure, you build a new belief system. In this system, profit isn't a sin, and loss isn't shame. They're simply variables in a professional process, where risk is part of the price of playing the game. The practical result is a trader who can size up when the stats call for it, scale down when the context shifts, and move forward without the unconscious weight of proving worth or avoiding guilt. This internal reset aligns conviction, skill, and outcome in a virtuous cycle of sustainable growth. In the world of trading, many beginners believe that confidence will only come after profit. They think they'll finally feel secure once the P/L turns green, once their bank account proves they're on the right path. But that mindset is a trap. Van Tharp, one of the foremost experts on trading psychology, explains that waiting for results before trusting the process is like trying to feel warmth before lighting the fire. True confidence doesn't come from profits. It comes from consistent behavior, and it's that consistency that eventually leads to sustainable profit. There's a simple but powerful model called belief, action, result. Belief shapes action, action produces results, and results reinforce the original belief. If a trader believes they can only act when they feel certain, they hesitate, they fumble their execution, and they end up with inconsistent outcomes, confirming their doubt. It becomes a vicious cycle. But when the initial belief is, I trust my process, even without immediate results, the trader acts with clarity, executes setups with conviction, respects stops, and generates more stable returns. That success builds genuine confidence and fuels a positive feedback loop. To develop that kind of conviction, you have to break the habit of judging everything by the money. Instead, professionals build an execution journal based on behavior. With each trade, they grade the entry, management, and exit as A, B, or C. A trade that hits stop loss can still earn an A if it followed the plan perfectly. A profitable trade that was impulsive might get a C. The goal is to reinforce the right habits, not to celebrate lucky wins. This kind of evaluation teaches the brain that confidence should be rooted in discipline, not in the randomness of a favorable candle. 1. Of the most striking examples of this principle is Ed Seykota, one of the pioneers of systematic trend trading using computers. During his early years trading futures, he went through long periods of drawdown. His system required patience and a tolerance for losses before big trends would pay off. Most traders would have abandoned the method under the emotional weight of watching their equity curve sink. But Seykota kept trading with conviction because he trusted the process more than the momentary result. When the cycles turned, he was still there, in position, and the profits came as an inevitable reward for his discipline. Real confidence doesn't come from the high of a winning trade. It's built quietly, day after day, in the routine, in nightly reviews and noting your mistakes, in the humility to learn from each candle, and most of all, in the courage to follow the plan even when there's no immediate reward. That kind of confidence comes before the result, and that's exactly why when the result does arrive, it lasts, because it isn't built on luck. It's built on a foundation forged within the trader. Confidence comes before profit because it's the structure that holds it up. Traders who understand this stop looking to the chart for validation and start building it from the inside out. They trade anxiety for conviction, and in doing so, they trade luck for mastery. In the financial markets, winning isn't about fighting everything all the time. More often than not, a trader's true power lies in knowing when to let go, when to stop resisting, when to stop battling the market, and simply accept what's right in front of them. This is the paradox of surrender. It's a deeply counterintuitive idea for beginners, but one that becomes a turning point for those seeking consistency. Inspired by Taoist philosophy, this principle teaches that water overcomes rock not through force, but through persistence and flexibility. In trading, that means the best traders aren't the most aggressive. They're the most aware. The trader who resists the market's reality becomes tense, impulsive, and vulnerable. They try to force entries that aren't there, hold on to money, trades out of pride and increase risk to prove their analysis right. On the other hand, the trader who surrenders to uncertainty isn't giving up. They're recognizing the difference between what can and cannot be controlled. They understand that the market is a force far greater than their personal will. Instead of trying to dominate the flow, they adapt to it with lightness and presence. This mental state of acceptance is what many researchers call the flow state. When a trader is in flow, they're not overthinking, not forcing decisions, not fighting the chart. They simply execute as if the market and their actions are in sync. Studies on heart rate variability, or HRV, show that traders in flow experience physiological coherence between heart and breath. Their heartbeat becomes steady, their mind enters a relaxed focus, and decisions come with clarity, even in high-pressure scenarios. It's in this state that true intuition starts to work. One powerful technique to cultivate this surrender is what I call market meditation. Every day before the session or during off hours, the trader simply watches the ticks move across the screen for at least 15 minutes. No clicking, no searching for entries, just watching with full attention. The goal is to train the brain not to react. It's an exercise in mental silence amid the chaos. Over time, this practice reduces impulsivity and teaches the trader to recognize patterns with greater sensitivity without the urge to act immediately. A classic example of this principle in action came from Paul Tudor Jones during the 1987 crash. While many funds collapsed trying to predict the market's irrational behavior, Jones did the opposite. He let go of the need to call the bottom, reduced his position sizes, cut risk, and simply observed. His priority was capital preservation until the environment became clearer. That strategic surrender saved his fund and allowed him to return, even stronger in the cycles that followed. The paradox of surrender teaches that letting go of control isn't weakness, it's emotional intelligence. Accepting that we don't know what comes next frees the mind to act with precision. The trader who surrenders to market reality isn't passive. They're present. They act when it's time and step back when it's not. That fluidity, that respect for the natural movement of price, is what separates tense amateurs from calm professionals. In the end, the market doesn't reward those who try the hardest. It rewards those who align the best, and that alignment begins the moment you stop trying to control everything and start watching with humility, patience, and awareness. Napoleon Hill warned that no external enemy is more powerful than the inner voice that persuades us with seductive logic. In trading, that voice always sounds rational. It convinces the trader that watching one more technical live stream is more valuable than reviewing their own journal. It promises that tweaking the setup will fix the drawdown and suggests that skipping sleep to catch the Asian session is a sign of true commitment. But behind this logical facade lies the invisible cost of self-sabotage, a constant drain of focus, energy, and emotional capital that keeps your learning curve stuck in place. To identify this hidden leak, start with a simple 3-point checklist. First, overanalysis, the excess of study that replaces deliberate practice. If you're spending hours consuming content every day but haven't executed 100 trades on a demo or real account with controlled risk, you're feeding the illusion of progress while avoiding the discomfort of losing and winning real money. Second, skipping your sleep routine, a common reaction after a losing streak. By sacrificing rest, you impair the executive functions of the prefrontal cortex, exactly the part of your brain responsible for discipline and decision-making right when you need it most. Third, changing your trading plan after a short losing streak. If you abandon a system before it reaches statistical significance, you'll never know if it works, and you'll stay trapped in the endless cycle of chasing the next holy grail. One case I followed illustrates this perfectly. Renato, a futures trader with 2 years of experience, used a breakout strategy with a win rate of around 55% when executed with a fixed stop of twice the ATR. After 5 consecutive losses, he gave back 14% of his capital. Instead of reviewing his records and accepting variance, he spent the weekend digging through forums looking for new filters. On Monday, he changed the rules, added more indicators to his screen, and increased position size to make it back faster. The result? 3 more losing trades, now larger, followed by caffeine overdoses and sleepless nights trying to test overnight markets. Within 3 weeks, he had lost double what he was trying to recover. Escaping discomfort looked like hard work, but it was actually self-sabotage disguised as diligence. The best defense against this enemy is building an external system of accountability. Set up an accountability partner. Choose someone with similar goals and schedule a daily exchange of discipline reports. This report doesn't focus on profit, but on process metrics, hours of sleep, presence during the pre-market session, number of trades aligned with the setup, adherence to the loss limit. Knowing someone else will see your numbers shrinks the mental space for internal excuses and increases your commitment to the plan. Behavior change studies show that the likelihood of maintaining a desired habit jumps from 35 to 65% when you report regularly to someone equally invested in the goal. When you strip away the rational polish from your excuses, you realize that self-sabotage isn't a moral failure, it's a defense mechanism against the discomfort of uncertainty. Facing it requires awareness, structure, and humility. Observing the pattern, documenting the routine, and being accountable to a partner turns the invisible enemy into a visible process. Only then can the trader reclaim the energy once wasted on detours and redirect it toward what truly matters, sticking to the plan, refining the method, and allowing the equity curve to reflect dedication, not avoidance. From the moment you hit the entry button, the best thing you can do is quiet your mind. That idea feels unsettling. because the ego believes it needs to monitor every price movement to protect capital. But paradoxically, overthinking distorts perception and leads to premature interventions. Robert Koppel and Howard Abel explored this dilemma in Zen in the Markets, showing that while a trade is born from analysis, it grows in silence. You investigate, define your risk and target, and then trust the plan. It's like shooting an arrow. Once it's released, overthinking doesn't correct its course. It only ruins the next shot. The physiological key to this silence lies in the balance between the sympathetic nervous system, which gears up the body in the face of risk, and the parasympathetic system, which induces relaxation. Right after you place a trade, the sympathetic system kicks in because your money is on the line. If the trader doesn't intervene, this heightened state lingers, and any noise on the chart gets interpreted as a threat. To bring balance, use box breathing, also known as 4-square breathing. Inhale for 4 seconds, hold your breath for 4, exhale for 4, and remain with empty lungs for 4. Repeating this cycle for 1 minute increases heart rate variability, a physiological marker of coherence studied by researchers like Stephen Porges. With your heartbeat steady, the prefrontal cortex regains control and your attention span expands, allowing you to observe the market without the constant urge to interfere. This state of presence ties into the Taoist concept of Wu Wei, often translated as non-action. In trading, non-action means building systems that reduce the temptation to interfere based on fleeting emotions. An automatic trailing stop is a practical expression of Wu Wei. You program the platform to move protection up with each price, level, and then step away. You delegate management to the algorithm so the mind can remain an observer, not a factory of justifications. The trader shifts from anxious protagonist to guardian of the process, willing to accept both continuation and reversal without inner resistance. Some major trading desks take this logic to the extreme. In the past decade, Nomura implemented an unusual rule at one of its prop desks. After placing an order above a certain size, the trader was required to get up and leave the desk for 15 minutes. This prevented compulsive micromanagement of large positions, which often led to defensive overtrading. Physically stepping away broke the cycle of nervous monitoring and forced the trader to trust the setup. Performance reports showed a drop in manual adjustments and an increase in average risk-reward per trade, proof that less intervention can often lead to more profit. Silencing the mind between entry and exit isn't passivity, it's discipline. You're trading the noise of thoughts for a space of clear observation where market signals can be perceived without the distorting filter of fear or greed. Structured breathing, smart automation, and behavioral boundaries act as protective walls around this space. Inside it, the trader discovers that most of the mastery lies in allowing the price to move freely while keeping attention calm, ready to learn from every outcome instead of fighting to control it. Victor Spirandeo often says that the market doesn't reward those who react, it rewards those who respond. The difference between these two verbs may be subtle in the dictionary, but in practice, it's profound. Reacting is firing off orders, like a circuit breaker throwing sparks when a wire is touched. It's pure impulse, driven by fear and greed. Responding, on the other hand, means reading the context, absorbing the information, weighing the risk, and only then acting with intention. To internalize this distinction, it helps to bring in the OODA loop, observe, orient, decide, act, a model created by Colonel John Boyd for fighter pilots. In tape reading, this process translates to watching order flow, contextualizing the lot size within the book, estimating the probability of movement, and finally clicking. Most traders skip straight from the first to the last step. They see a large buy order and immediately jump in without processing whether that volume is truly institutional or just temporary spoofing. When the price pulls back, they blame the algorithm, but in reality, they skipped half the cycle. To break that automatic behavior, try a simple experiment. After every entry or partial, establish a rule. Any adjustment, whether it's moving a stop, increasing size, or taking profits, can only happen after 5 full seconds of conscious observation. This tiny delay might seem meaningless, but It creates a neural buffer between stimulus and reaction. It gives the prefrontal cortex time to assess whether the decision aligns with the plan or is just a burst of anxiety. Many traders report that when they introduce this pause, half their adjustments disappear because they realize they're unnecessary. The noise fades, the stats improve, and fewer emotional errors make their way into the APNDL. Responsiveness, however, does not mean slowness. When the context shifts clearly, you need to act without hesitation. George Soros gave a powerful example of this kind of risk-based agility during his legendary short against the British pound in 1992. He endured opposing moves until it became politically evident that devaluation was gaining ground. One morning, a sudden backache triggered a physical alert to the changing environment. He immediately trimmed part of his exposure, rechecked the data, and later doubled down once he saw that the initial stress didn't invalidate the macro thesis. His body sensed an inflection point. He listened, verified, and responded at the right time. That kind of rapid response, grounded in rational confirmation, is the opposite of blind reactivity. It's sensitivity transformed into calibrated action. By training the mind to follow the OODA loop, and by inserting small delays to filter out impulses, the trader builds an internal space where price fluctuations can be observed without the urgency to protect the ego. At the same time, they develop the readiness to shift direction quickly when the market narrative changes. Reactivity is the slavery of conditioned clicking. Responsiveness is the freedom to choose the exact moment that maximizes both technical and psychological edge. Mastery emerges when deliberate pause and decisive action coexist in the same operator, allowing them to move through chaos with clarity and conviction. Behind every setup lies a belief system silently guiding the trader's decisions. Alexander Elder reminds us that technique on its own is just a neutral tool. The difference between a consistent trader and an unstable one is the mindset projected onto that method. Two traders might use the exact same pullback on the 9-period moving average, follow the same risk management rules, and trade the same asset. But while one holds the trade until it hits a target 3 times the risk and trusts the plan, the other exits at the first sign of a pullback, afraid to watch the profit vanish. The chart is identical, but the outcomes are drastically different. The reason isn't in the analysis, it's in the beliefs each trader holds about money, self-worth, and control. A trader operating from a scarcity mindset acts as if every trade is their last chance to get it right. They don't trust their own system, constantly look for extra signals to justify what's already clear, and even when the price moves in their favor, they doubt the target will be hit. That doubt leads to premature exits, tightened stops, skipped entries, or impulsively increasing size in a desperate search for emotional validation. On the other hand, the trader with an abundance mindset doesn't rely on a single trade. They trust their edge because they've seen the market repeat the same behavior dozens of times. They know profits come as a natural result of the disciplined execution over many attempts. Their focus is on the process, not the immediate outcome. 2. Align technique with conviction. A powerful practice is writing a statement of intent before the session begins. This small handwritten ritual helps program the mind for clear execution. For example, today I trade with full awareness, follow my plan with discipline, and trust my setup because it has proven its value. I accept losses as part of the process and stay focused on execution, not isolated results. This type of affirmation conditions the brain to respect defined boundaries and reduces the influence of self-sabotaging beliefs in emotional moments. Another fundamental method for strengthening belief in your system is subjective backtesting. By reviewing 100 screenshots of ideal entries based on your setup, you train your eye to recognize patterns and reinforce confidence in the model. Unlike automated backtests, which provide cold data, manually studying chart prints allows you to clearly see the market's logic in action. This visual repetition creates a reflex of conviction. When the pattern appears in real time, your mind already knows it holds statistical value. That reduces hesitation, increases execution, speed, and reinforces trust in the plan. A setup is just an external structure. True performance comes from how the trader relates to that structure. You need an internal system strong enough to withstand the emotional pressure of the market. That system is built through daily rituals, deliberate practice, and ongoing self-awareness. The trader who neglects their belief work is always at the mercy of doubt and impulsiveness, even with a statistically sound strategy. But the trader who aligns their mind with their method turns each execution into an act of confidence and consistency. That's how a setup stops being just a drawing on the chart and becomes an extension of the trader's professional identity. The idea that discipline is a mental prison is one of the most destructive beliefs a trader can carry. Many believe they need freedom to improvise, to feel the market, to trade based on intuition. But as Jocko Willink, former U.S. Navy SEAL commander, famously said, true freedom comes from discipline, the freedom to operate with clarity, to stay calm in the chaos, to execute without hesitation. On the battlefield and in the markets, it's the firm rules that unlock the energy needed for strategic creativity. In trading, discipline begins before the opening bell. Elite traders follow a routine known as the morning brief, where they review market conditions, refine their operational plan, and align their intentions with the technical variables of the day. They don't open their charts looking for random opportunities. They enter the session with a plan, defined, tested, and written. At the end of the day, they perform an evening debrief, where they review their trades, compare them to the original. Plan, log any deviations, and extract lessons. This constant routine transforms the trader into a strategist, not just someone pressing buttons. This approach comes straight from the military. Elite units like the Navy SEALs follow strict checklists before every critical mission, especially during halo jumps, which require extreme coordination at high altitudes. Every step is reviewed in silence, with zero room for improvisation, because the smallest mistake could cost the mission or a life. In the markets, this same mindset is mirrored in the pre-trade checklist. The trader checks if the trend is clear, if risk is within limits, if the entry timing aligns with the setup. Nothing is done impulsively. Every trade follows a logical sequence. What may look like restriction is actually what prevents errors and preserves emotional energy. Mike Bellafiore, founder of SMB Capital, has shared that the most profitable traders on his desk aren't the most brilliant. They're the most disciplined. The ones who follow the playbook religiously, document everything, and never skip steps. His book, One Good Trade, teaches that operational excellence comes from the consistent repetition of a clear, efficient structure. A good trade isn't one that makes money. It's one that's executed based on solid criteria within predefined rules. And the more often that process is honored, the steeper the curve of consistency and confidence becomes. What most people see as limitation is actually the foundation for growth. Discipline removes emotional variables, reduces internal noise, and creates mental stability. It allows the trader to enter a state of flow more easily because there's no need to overthink every micro decision. Everything is already mapped out. The mind is free to observe, interpret, and respond with precision. And that's where true freedom lives, not in doing whatever you want, but in trading without internal interference, with control, clarity, and confidence. Discipline doesn't suffocate the trader. It protects them from their own chaos. It's the shield that keeps performance alive when the market comes to test the weak. The trader who learns to detach from immediate outcomes enters a whole new dimension of performance. Mark Douglas was one of the first to reveal that the key to consistency in the market isn't about predicting the next trade, but about trading with calm, even without knowing how it will end. He insisted that mastery comes from accepting randomness as part of the game. A system with a 50% win rate can produce extraordinary results if executed with discipline over a large enough sample size, and it can fail miserably if the trader quits before the edge has time to play out. To illustrate this clearly, just look at a Monte Carlo simulation using a 50% win rate and a 2-to-1 payoff. With 100 traders applying the same system, each one following a random sequence of trades, the end result will be a set of radically different equity curves. Some will end up at the top of the distribution, others at the bottom, even though the edge is identical. What determines who reaps the rewards isn't the system. It's the ability to stay in the game. And detachment is the tool that makes that possible. Without it, the trader abandons the strategy at the worst possible time, right after an inevitable string of losses. Detachment isn't giving up. It's trusting the process. And this mindset can be trained through simple, symbolic practices. One example is the ritual known as closing bell gratitude. At the end of each session, the trader takes 2 minutes, takes a deep breath, and writes down or speaks out loud something they learned or did well that day, regardless of the financial result. It might be the patience to wait for the right entry, the discipline to respect a stop, or even the courage to stay out of a messy market. This habit shifts the focus from outcome to correct action, reinforcing professional identity and weakening attachment to short-term profit. Another powerful example comes from the old pit traders at the CME in Chicago. Many veterans would toss part of their profits into a hat in the center of the trading floor, destined for charity. It wasn't just generosity. It was mental training, a practical way to show the ego that the money didn't define them, that what mattered was how well they traded, not whether they won or lost on a particular day. That kind of ritual breaks the emotional dependency on the P&L and builds an anti-fragile mindset, one that can endure rough cycles without falling. Apartheid, the trader who operates with detachment, doesn't get euphoric on a win or devastated by a loss. They understand that each individual trade is irrelevant in the context of a large sample. They know their job is to execute with excellence and let the math work over time. And by thinking this way, they free their mind from the anxiety that destroys so many talented traders. Detachment is the bridge between technical knowledge and consistent execution. Without it, the edge dies in hesitation. With it, every trade becomes just one more step on a long-term journey where the true reward isn't the money, but mastery over yourself. In the world of trading, there is a lot of talk about the fear of losing, but very little is said about an even more silent and destructive trap, the fear of winning. This fear doesn't show up in obvious ways. It doesn't scream hesitation or panic. It hides behind exaggerated caution, behind a false sense of humility, behind a seemingly wise emotional restraint that quietly sabotages your progress. The trader who carries this belief doesn't notice, but when profits begin to grow, their unconscious mind subtly starts looking for ways to hit the brakes. And it does it flawlessly because deep down, they don't truly believe they deserve Empoleus. Mark Douglas warned that the market is a mirror of our self-image. If a trader sees themselves as someone who can't go beyond a certain financial level, any performance above that ceiling will feel like a threat, not an achievement. The signs of this self-sabotage become clear once you know how to spot them. One of the most common is using overly tight trailing stops after a winning streak. It looks like risk management, but it's really a disguised exit strategy born from discomfort with success. Another frequent pattern is a sudden drop in performance right after hitting a personal record. The trader starts changing setups, misses entries, loses timing, and drifts away from their method. The market didn't change. Their psychology did. In many cases, this behavior is rooted in childhood stories or inherited family beliefs. One striking example was a trader who always gave back a large portion of his profits whenever he crossed a certain threshold. During coaching sessions, he revealed that his father used to say things like, "Rich people are selfish and dishonest," or "Those who rise too fast always fall." That voice from the past was still calling the shots, without him even realizing it. Excessive profit felt like a betrayal of his emotional loyalty to his family roots. Earning beyond a certain point became a form of disloyalty. To dismantle this trap, techniques adapted from EMDR, a method originally designed to treat trauma, can be applied. The goal is to desensitize the negative emotion tied to high profits and reprogram the emotional response to them. This can be done with simple, guided visualizations. The trader closes their eyes and imagines a perfect trade, watching the profit grow steadily until it breaks past a number that would usually trigger discomfort. When that moment comes, they pay attention to the sensations in their body: tension, tightness, anxiety. Instead of pulling away, they take a deep breath and stay there, allowing the nervous system to learn that it's safe to hold on to success. With repetition, the body stops reacting with alarm and begins to treat growth as something normal. Winning takes more than skill. It takes an identity that matches success. If a trader doesn't see themselves as someone capable of sustaining what they've earned, they'll unconsciously give it back. The fear of winning is just a reflection of the fear of becoming someone greater than you've always been. Overcoming it is an internal construction process. It's about expanding self-image and aligning your sense of worth with your results. And when that happens, profit stops being a lucky break and becomes the natural outcome of someone who already sees themselves as a winner. Brett Steenbarger, psychiatrist and mentor to institutional traders, was one of the first to show that a chart isn't just a tool for technical analysis, it's a psychological mirror. The market doesn't just show price, it reveals who you are under pressure. Every candle that moves against your position, every moment of hesitation or emotional rush, is an invitation to observe how your emotions interfere with your decisions. The trader who understands this stops looking for the enemy outside and starts investigating their own reactions. And from that point on, the chart becomes an extension of the mind. When you start trading, you bring an emotional history with you. Fears, expectations, past traumas, beliefs about money and success. These don't stay outside the screen. They show up in impulsive entries, rushed exits, the obsession with recovering losses, or the inability to hold on to a winning trade. That's why every trader must develop the ability to recognize emotional patterns before they turn into recurring mistakes. Steenbarger calls this self-talk pattern recognition. The idea is simple yet powerful. Pay attention to the things you tell yourself during critical trading moments. Just one more click. If I miss this move, I'll regret it. I need to make it back now. These phrases are emotional triggers that often come right before impulsive actions. And over time, they can be mapped as psychological. Warning signs? A practical way to apply this concept is by combining chart analysis with emotional journaling. Collect screenshots of trades where you deviated from your plan. Under each image, write down the dominant emotion you felt at the time of the decision. Fear, frustration, urgency, relief, anger. The goal isn't to judge, but to identify the pattern. With time, you'll notice that certain emotions consistently show up before certain mistakes. This awareness transforms your relationship with trading. You stop fighting the chart and start observing the internal triggers that are trying to control your execution. After several sessions, you'll begin to notice that your mistakes follow a kind of self-destruction setup. It doesn't matter what technical strategy you use. If you don't address the emotional patterns that come before your deviations, you'll end up repeating the same cycle in a different disguise. For example, a trader who jumps in too early out of fear of missing the move often does so after a string of frustrating trades. The trigger isn't in the candle, it's in the accumulated emotion. Another trader who cuts profits too quickly may be unconsciously avoiding the discomfort of watching the market pull back, even if that means destroying their planned risk-to-reward ratio. Once these patterns are mapped, they can be deconstructed and replaced with conscious responses. The market won't give you more than you're ready to hold. It will reflect your shadows until you're willing to confront them. Every breakout you chased out of anxiety, every pullback you skipped out of fear, every oversized position driven by greed, they're internal reflections that need to be understood. The trader who examines themselves with the same seriousness they apply to chart analysis eventually discovers that the real winning setup isn't on the screen, it's in the mind. And when that alignment happens, consistency stops being a distant promise and becomes a natural outcome. Every chart is neutral until our eyes land on it. From that moment on, beliefs and expectations begin to fill in the blanks, turning random curves into convincing stories. John Murphy explains that trend lines are objective tools, but psychodynamics adds that what we unconsciously expect tends to emerge before our eyes. The brain, shaped by evolution, is wired to recognize familiar patterns in visual noise, a phenomenon known as pareidolia. It's the same instinct that makes us see faces on the moon or animals in the clouds. In trading, this instinct turns fluctuations into imaginary head and shoulders patterns or perfectly parallel channels drawn only after the fact. And when price moves against the projection, the trader doesn't see a reading error. They see injustice. The image was so vivid, it felt as real as a photograph. To escape this trap, the first step is to admit that the mind selectively distorts information to confirm its internal narrative. A simple way to expose this bias is with the blind test method. Open a chart and hide the right side. Say, the last 20 candles. Mark support and resistance levels, possible patterns, without knowing what happens next. Only then reveal the hidden section. If price easily cuts through your levels, it's a sign your markings were more about wanting to see a pattern than about sound technical reasoning. Repeat this exercise daily until your levels hold up over time in at least half of the cases. This kind of practice sharpens your neutrality and reduces cognitive projection. Another powerful technique is trading with the chart flipped upside down. Most platforms offer a flip chart function, or you can simply multiply price data by -1 in a spreadsheet and plot the result. When the chart is inverted, directional bias disappears, and with it, part of your emotional attachment. A trader who swears they see an unstoppable uptrend often hesitates to take a short when the exacto same structure appears inverted. That hesitation reveals their conviction wasn't rooted in price structure, but in psychological attachment to a preconceived direction. Flipping the chart for a few sessions challenges that conditioning and trains your eye to evaluate setups based on statistical symmetry, not wishful thinking. The goal here isn't to eliminate chart interpretation, but to cleanse it of the automatic reflexes that turn every rise into a breakout and every pullback into a bargain. By consciously seeking your blind spots, you weaken the tendency to project personal stories onto the market. Only then do Murphy's lines return to their true purpose, serving as impersonal guides of probability rather than canvases for ego-driven fantasies. The trader who masters this neutrality transforms the chart into a faithful mirror of market reality, not a projection of imagination, and begins making decisions based on solid evidence instead of cognitive mirages. Most beginners treat risk management as a technical afterthought, something to adjust once their strategy is dialed in. Seasoned pros like Howard Marks take the opposite approach. They first learn how to survive, then focus on making money. This reversal of priorities explains why so many traders with brilliant setups blow up, while boring strategies quietly endure for years. Survival is the real secret, because every edge needs time to play out. And without capital, there is no time. Mathematically, the balance between growth and preservation can be illustrated by the Kelly criterion, which calculates the optimal fraction of capital to risk on each bet, based on win probability and payoff ratio. When these variables are stable, the formula may suggest risking 5%, 8%, or even more. It sounds appealing, but it runs into two major pitfalls: the accuracy of your assumptions and the psychological impact of drawdowns. A small error in estimating win rate can multiply the risk of ruin. That's why professional money managers replace full Kelly with much smaller fixed fractions. The consensus among proprietary trading desks is around 2% per trade. That number isn't arbitrary. If a trader suffers 10 consecutive losses while risking 2%, they'll still have about 82% of their capital intact, enough to recover when the edge returns. But with 5% per trade, the same streak would leave the account at just 60%, requiring a 67% return just to break even. A psychologically crushing burden. Brokerage data reinforces this logic. When you chart a survival curve, the percentage of active accounts over time, the sharpest difference isn't the setup being used, but whether traders use fixed stops and moderate position sizing. Accounts without stops or with more than 4% risk per trade start vanishing from the chart within months. Meanwhile, accounts that stick to 1% or 2% risk show a slower decline, giving the trader time to learn and adjust. Bill Dunn, a pioneer in trend following, took this philosophy to the extreme. His fund tolerated drawdowns of up to 50%, a figure that would make most investors run for the exits. But what few realize is that his individual position sizes were small enough to avoid mathematical ruin. Dunn accepted large volatility in exchange for not having to reduce his edge when real trends emerged. By protecting capital through conservative sizing, he allowed profits to run without panic. The combination of financial stamina and statistical conviction turned brutal drawdowns into just another chapter in a multi-decade journey. Risk management isn't about avoiding losses. It's about designing the game so that no single trade or losing streak can take you out. Moderate leverage, technically justified stops, and a predefined financial cap form the steel triangle that supports the trader when the market turns predatory. With that structure in place, each trade is no longer an existential gamble. It's just a small piece of a much larger mission. And in that mission, winning becomes a byproduct of staying in the game long enough for the math to fulfill its promise. Imagine a trader who buys an asset, watches the price come within a single tick of the target, only to reverse and hit the stop. That loss, no matter how small, often triggers a disproportionately emotional reaction. The brain, instead of accepting the loss as a statistical part of the process, reacts as if it had almost won. Neuroeconomics calls this the near-miss effect, and in trading its impact can be devastating. The closer a trader gets to a potential gain, the more the brain's reward circuitry lights up as if the win actually happened. It's the same effect that fuels addiction to slot machines. Those machines are designed to frequently display two matching symbols, with the third just barely missing. Neuroscientists have shown that these near wins release almost as much dopamine as real victories, keeping the player hooked. In the markets, this plays out as impulsive behavior like revenge trading, where the trader chases that 1 cent that slipped away, convinced the market owes them something. It's a cognitive trap, because the focus shifts from the plan to the ego, and once the ego takes over, discipline disappears. What's most dangerous is that this kind of frustration doesn't come from big losses. It comes from the trades that were almost wins. Experienced traders know that a clear loss, especially one outside the plan, hurts less than a stop-out that came after price moved 90% toward the target. It warps the sense of control and can spark a cascade of irrational decisions. The obsession with the almost becomes fuel for reckless trades, not aimed at profit, but at emotional satisfaction. To avoid falling into this trap, one of the most effective strategies is turning off the P&L panel during the session. Floating profit and loss acts as an emotional trigger, constantly comparing each tick to what almost was. Trading with a focus on tick counts, position size, or technical patterns instead of dollar values helps neutralize the human tendency to react emotionally to money. Many high-performance traders use blind charts with no price labels, simply to preserve a neutral mental state. Another powerful tool is behavioral journaling, where the trader records not just trade outcomes, but the level of perceived frustration after each one. This helps identify self-sabotage patterns tied to near-miss losses. Becoming aware of those patterns is the first step toward dismantling their influence. At its core, the near-miss syndrome isn't about strategy. It's about biology. It's the brain's primitive instinct trying to find emotional meaning in random events. The true professional understands this and builds safeguards. They accept that the market is a casino with a statistical edge in their favor, but they also protect their mind as if it were their most valuable form of capital. Because it is. Conviction doesn't come from a class, a YouTube video, or a single successful trade. Conviction is built in the silence of repetition. A trader doesn't become consistent because they know what to do, but because they've trained so much that both mind and body respond with precision, even in the face of uncertainty. James Clear, in Atomic Habits, puts it simply, habits are the compound interest of self-improvement. And in trading, that interest is what separates the impulsive amateur from the calm professional who performs under pressure. Every habit follows a cycle, trigger, routine, reward. It's called the habit loop. To build real trading conviction, this loop must be created with intention. Trigger, a fixed time, for example, 8:30 a.m. Routine, reviewing the playbook, simulating scenarios, rewriting entry, and exit rules. Reward, mentally reinforcing that this preparation is shaping a winning mindset. Traders who just jump on the screen without any pre-market ritual tend to trade based on emotion, not structure. Neuroscience shows that 21 days isn't enough to form a solid habit. Newer studies suggest it takes an average of 66 days for a behavior to become automatic. In trading, that means 2 months of sticking to the same routine before the brain stops resisting. That's why so many give up before they ever become consistent. They mistake knowledge for competence. Knowing what to do doesn't change anyone. Doing what you know until it becomes part of who you are, that's what changes everything. Richard Dennis understood this when he trained the legendary turtles. Before they ever touched real capital, he put them through weeks of daily drills, simulated order placement, spreadsheet reviews, chart analysis without the current candle. It was the repetition that created conviction. The traders learned that it wasn't about trusting the market, it was about trusting the system. Conviction doesn't come from analysis alone, but from repeating that analysis. It doesn't come from backtesting, but from emotionally digesting the same setup, working 100 times across different contexts. Traders who walk this path build a kind of psychological muscle that protects them in critical moments. They don't panic after a losing streak because they trust the statistics embedded in their brain. They don't exit early out of fear because they've seen the move reach target again and again. They don't switch strategies in a moment of frustration because their mind already knows that's just noise. Repetition isn't glamorous, it's raw discipline. But it's what turns charts into fluent language, setups into instinct, and routine into freedom. While others chase the hidden secret, the real trader is there every single day, repeating what works until it works effortlessly. That's the real secret behind unshakable conviction. Most traders focus all their attention on the screen and forget that the body is also trading the market. Biofeedback studies from institutional desks have shown that high heart rate variability, a sign of balance between the sympathetic and parasympathetic systems, is directly linked to more objective decision-making. When your breathing shortens and your heart rate spikes, blood flow is redirected away from the prefrontal cortex, the area responsible for planning and self-control, toward survival regions of the brain. At that point, the chart is no longer being interpreted with logic, but through the lens of fear or euphoria. That's why training your physiology is just as critical as studying technical analysis. One of the simplest ways to regulate the nervous system is through coherent breathing. This involves inhaling for 5.5 seconds, exhaling for 5.5 seconds, creating an 11-second cycle that synchronizes heartbeats and blood pressure waves. Do 30 cycles, about 5 minutes, before major news releases. HRV sensors show that this practice quickly boosts cardiac coherence, lowers cortisol levels, and puts the brain into a relaxed state of focus, the ideal zone for assessing risk. Without emotional distortion, posture also plays a major role in biochemistry. Ergonomic studies reveal that leaning forward toward a monitor for extended periods can increase cortisol levels by up to 15%, even at rest. When the lower back lacks support, the lungs compress and breathing naturally becomes shallow. The fix is to adjust your chair so that your hips and knees form a slightly open angle, keep the monitor at eye level, and rest your forearms on the desk to relieve shoulder tension. This alignment reduces involuntary muscle strain, improves oxygen flow, and prevents micro spikes of adrenaline that often go unnoticed, but slowly chip away at your objectivity throughout the session. To bring these practices into daily life, many professionals use wrist devices that track heart rate variability in real time. The sensor feeds data into an app, which alerts the trader when HRV drops below a personalized threshold, signaling that the body has entered an alert state. When that happens, the trader takes a 60-second break, performs 2 rounds of coherent breathing, and only then returns to the screen. This micro break might seem minor, but it prevents the physiological threat response from snowballing into a series of impulsive decisions. In internal backtests at quant funds, this simple intervention reduced execution errors by 20% during high volatility periods. The body is the hardware running the software of reasoning. Ignoring this machine is choosing to let your decision-making rely on biochemical chance. When breathing, posture, and physiological feedback work together, the trader gains an invisible edge, constant clarity, and in that state, every click reflects analysis, not reaction. That kind of physiological consistency is what sustains financial consistency. There's a deep reason why the best traders in the world simply don't share this secret. It's not out of selfishness. It's not because they're hiding something. It's because this kind of wisdom doesn't fit into a PDF, can't be passed on in a recorded mentorship, and won't reveal itself to anyone who hasn't bled emotionally on the battlefield of their own mistakes. What separates the average trader from the professional isn't the setup, the broker, or even the level of technical knowledge. It's the depth to which they've faced their own mind in the middle of chaos and walked out with clarity, not empty promises. Picture a Japanese dojo. The master teaches the sword movements with surgical precision. That's the kata. But the student only truly understands it when, in real combat, with fear and sweat, their body executes the move with instinctive flow. Until then, it was just imitation. Trading works the same way. You can study every strategy, memorize statistics, follow every guru, and pay for rooms filled with perfect calls. But until you live the market with pain and humility, your mind will fail you the moment you need it most. I've watched the same pattern for decades. Traders pay a fortune to join prop firms, read all the right books, attend every lesson in the program. Yet they only start to evolve after taking losses with their own money. Not because they enjoy suffering, but because only when your emotional capital is at risk do you uncover what's hiding beneath the surface. Fear, impatience, the need for approval, attachment to outcomes, pride that won't let you admit the entry was wrong. No textbook prepares you for that. This is the part of the market that you can only understand by living it. That's the real secret, the one that can't be taught, only built. It's the ability to face yourself in the mirror every day, in silence, without guilt or excuses, and see the truth. You are in control of your own learning curve. Sometimes you win, other times you lose. But if you keep showing up with honesty, with discipline, and with statistics instead of emotion, there comes a point where the illusions fall away. And what's left is just you, the chart, and reality. That's the moment you become dangerous. Now, tell me this. What was the moment the market taught you a lesson no course ever could? Share it in the comments because your story might awaken other warriors who haven't yet realized that the real breakthrough happens on the inside.